If you've spent any time in precious metals communities, you've heard this claim. COMEX silver is rigged. Big banks manipulate prices through naked shorts. The whole thing is a scam designed to suppress silver. And here's the thing. Some of that narrative is based on real events. JPMorgan paid nearly $1 billion in fines for precious metals manipulation. Banks have been caught spoofing, so illegal activity has happened. But does that mean the entire COMEX silver market is rigged right now? That prices are completely fake? That physical and paper are totally disconnected? I went through the actual trading data, court documents, and market mechanics to separate what's proven from what's speculation. I'm Alex Morgan. On this channel, we look at financial markets using data, not narratives. No products to sell, just honest analysis. Disclaimer. This is educational content, not investment advice or legal opinion. I'm showing you how to read the data yourself. Here's what we're covering. First, what manipulation actually happened and what courts proved. Second, how COMEX silver trading actually works. Third, what current trading data shows about market function. Fourth, the difference between manipulation and normal market behavior. And finally, how to spot real warning signs versus conspiracy theories. Let's start with what actually happened. Part 1. What manipulation was proven? Let's be clear about the facts. Manipulation in precious metals markets has been proven in court. This isn't conspiracy theory, it's documented reality. In 2020, JPMorgan Chase agreed to pay $920 million to settle charges of spoofing and manipulation in precious metals and treasury markets. The conduct occurred between 2008 and 2016. And what is spoofing? It's placing large orders you intend to cancel before execution, creating a false impression of supply or demand. Traders would place big sell orders to push prices down, then cancel those orders and buy at the lower price, or vice versa. The Commodity Futures Trading Commission proved this happened. Traders were convicted. Banks paid fines. In 2021, Deutsche Bank settled for $60 million for similar conduct. Other banks have faced penalties too. So yes, illegal manipulation occurred. That's fact. But here's what people miss. The manipulation wasn't big banks suppressing silver to zero forever. It was individual traders making illegal trades for short-term profits, typically moving prices by pennies or dollars for minutes or hours, not suppressing silver for years. The CFTC didn't find evidence of a massive conspiracy to keep silver prices permanently low. They found traders breaking rules to skim profits from short-term price movements. That distinction matters, because it tells us what to actually look for in current data. Part 2. How COMEX actually works. To understand whether COMEX is rigged now, you need to understand how it functions. COMEX is a futures exchange. Silver futures contracts represent 5,000 ounces each. When you buy a contract, you're agreeing to take delivery of silver at a future date, or more commonly, you'll close the position before expiration. About 98% of contracts settle in cash, not physical delivery. This is normal. Futures markets exist for price discovery and hedging, not just physical delivery. Here's who uses COMEX. Miners who want to lock in selling prices for future production. If you're running a silver mine, you might sell futures contracts to guarantee revenue even if prices drop. Industrial users who need to lock in buying prices. If you manufacture solar panels, you might buy futures to guarantee supply costs. Investors and speculators who want exposure to silver price movements without storing physical metal. Market makers who provide liquidity by buying and selling continuously. The key point, most participants don't want physical silver. They want price exposure or hedging. That's why cash settlement is normal, not suspicious. Physical delivery happens through the warehouse system. COMEX has approved warehouses that store silver. Some is registered, available for delivery. Some is eligible, stored, but not available for delivery unless the owner registers it. When someone demands delivery, they get a warehouse receipt for silver stored in these facilities. They can then take physical possession or leave it stored. The system has functioned for decades. Delivery failures are extremely rare. When registered inventory gets low, eligible inventory can be converted or silver can be deposited. Now let's look at current trading data. Part 3. What current data shows. If COMEX silver is currently rigged, we'd expect to see certain patterns in the data. Let's check. Pattern 1. Massive short positions with no physical backing. The CFTC publishes commitments of traders reports every week. These show positioning by different trader categories. In late 2024, commercial traders, miners, industrial users, banks providing hedging, hold net short positions of roughly 40,000, 60,000 contracts. That represents 200, 300 million ounces. Is this naked shorting with no physical silver? Not necessarily. Miners short sell their future production. Banks hedge their customer positions. Much of this is backed by actual or future physical silver. Pattern 2. Divergence between paper and physical prices. If paper markets were completely disconnected from physical reality, we'd see massive sustained premiums over spot price. In 2024, retail premiums on silver coins ranged from $3 to $8 over spot, averaging around $4 or $5. Yes, premiums exist, but they're not $20 over spot. Physical prices roughly track COMEX prices, with premiums reflecting manufacturing costs and retail demand. When physical demand truly overwhelms supply, premiums spike. We saw this in 2020, 2021 with $10+ premiums. Current premiums are elevated but not extreme, suggesting the paper market is roughly reflecting physical reality. Pattern 3, delivery failures or refusals. COMEX publishes delivery data monthly. In 2024, thousands of contracts have gone to delivery without issues. People who demand physical silver are getting it. Yes, registered inventory fluctuates. Sometimes it drops to 50 or to 60 million ounces. But that's still 10,000+ contracts worth of deliverable silver. Ineligible inventory can be converted if needed. There have been no delivery defaults, no failures to deliver silver when demanded. Pattern 4, price movements disconnected from fundamentals. Silver prices in 2024 have responded to fundamental factors: dollar strength, interest rates, industrial demand data, geopolitical events. When inflation data comes in hot, silver rises. When the dollar strengthens, silver falls. When industrial demand projections increase, silver rises. This suggests price discovery is functioning, not pure manipulation. Could manipulation still be happening? Possibly. But current data doesn't show the hallmarks of systematic, overwhelming manipulation. Part 4. Manipulation versus normal market behavior. Here's where people get confused. They see things that look suspicious, but are actually normal market behavior. Example, large sell orders appearing and disappearing. In modern electronic markets, algorithmic traders place and cancel orders constantly. High-frequency trading firms might place thousands of orders per second, canceling most of them. This isn't necessarily spoofing, it's how modern market making works. Spoofing is placing orders you never intend to execute, specifically to manipulate price. Legitimate market making involves placing orders you might execute depending on market conditions, and canceling when conditions change. The difference is intent and pattern. Regulators look for patterns where traders consistently place cancel trade in the opposite direction. That's illegal. Just canceling orders isn't. Example, price drops on high volume with no news. Sometimes large institutional players need to exit positions quickly. A hedge fund liquidating 5,000 contracts will move the market. That's not manipulation. That's legitimate selling pressure. Manipulation would be placing fake sell orders to push the price down, then buying at the artificially low price. Example, silver falling when it should rise. Markets don't always behave logically. Sometimes silver falls, despite positive fundamentals, because sellers have more urgency than buyers that day. That's not rigging, that's market dynamics. So how do you tell the difference? Part 5. How to spot real warning signs. If you want to monitor for actual manipulation, here's what to watch. Red flag. 1. Delivery failures or suspensions. If COMEX can't deliver physical silver when demanded, that's a major red flag. This hasn't happened, but it would be obvious if it did. Red flag 2, massive sustained divergence between physical and paper prices. If retail premiums stay at 15-20+ over spot for months, that indicates serious disconnection. Brief spikes during supply crunches are normal. Permanent divergence would signal problems. Red flag 3, regulatory investigations or fines for current activity. The CFTC and DOJ investigate manipulation. When they find it, they announce it. If you hear about ongoing investigations into silver markets, that's worth noting. Red flag 4. Exchanges changing rules mid-crisis to prevent delivery. In 2021, some brokers restricted trading in certain stocks during the GameStop situation. If COMEX suddenly changed delivery rules to prevent silver delivery during a squeeze, that would be extremely suspicious. Red flag 5. Whistleblower testimony from market participants. If actual COMEX traders or bank employees come forward with evidence of ongoing manipulation, that matters. Speculation from people not involved in the markets is different from insider evidence. What's not a red flag? High trading volume relative to physical production. This is normal for all commodity futures. Large short positions by commercials, miners, and industrial users legitimately hedge. Prices moving against your position. Markets don't care about your trades. People on YouTube saying it's rigged, not evidence. Conclusion. So is COMEX silver rigged? Past manipulation proven. Banks paid billions in fines. Traders went to jail. This happened. Current manipulation, not proven by available data. Trading patterns look relatively normal. Delivery is functioning. Physical and paper prices are correlated. No delivery defaults. Could subtle manipulation be happening? Maybe. Markets aren't perfectly efficient or perfectly honest, but current evidence doesn't support claims of massive systematic price suppression. What we have is a functioning but imperfect futures market where legal hedging and speculation happen constantly. Illegal behavior has occurred and been punished. Current oversight is stronger than in the 2008-2016 period. Physical delivery works when demanded, prices respond to fundamentals. My advice, watch the data, not the narratives. Monitor COMEX inventory, delivery statistics, and premium trends. If those start showing real stress, you'll know. Until then, don't assume everything is manipulated just because prices aren't doing what you hoped. If you found this useful, hit the like button. Subscribe for more data-driven analysis. And drop a comment. What other market manipulation claims should I investigate? Gold? Bitcoin? Let me know. Thanks for watching. Stay curious, stay skeptical, and I'll see you in the next one.